All right, so are you ready to get your feet wet in the stock market?
I like that analogy.
Yeah.
Get your feet wet.
Yeah, because today we are diving deep into Warren Buffett's world.
Okay.
We've got a stack of sources here.
Oh, yeah.
Articles, videos, even snippets from his famous shareholder meetings.
hmm
And let me tell you, there's some seriously valuable stuff in here, especially for someone just starting out like you.
Yeah, and you know what's so fascinating about Buffett is that his approach is surprisingly simple.
Yeah.
You don't need like a fancy finance degree to grasp the core principles.
Right.
In fact, he often says that investing is more about temperament than intellect.
Okay, so where do we even begin with this mountain of Buffett wisdom?
Let's start with something Buffett stresses constantly.
Okay.
Understanding the businesses you invest in.
Okay.
It sounds obvious.
Yeah.
But so many people get caught up in the hype and forget this basic rule.
So it's not just about picking a company with a cool name or a trendy product.
Exactly. Think of it this way. Would you invest in a restaurant if you had no idea how restaurants work?
Probably not.
Probably not. You'd want to understand the menu, the costs, the competition, right?
Right.
The same applies to any business you're considering investing in.
That makes sense. Stick to what you know.
Right.
But even Buffett admits that there are industries he just doesn't get, like those super complex biotech companies.
Right. And that's actually a really empowering lesson.
Yeah.
Even the Oracle of Omaha has limits.
But it's okay to admit that?
It's okay to acknowledge that some things are just outside your circle of competence.
Yeah.
In fact, recognizing those limits can save you from making costly mistakes.
So step one,
Yeah.
don't be afraid to say, I don't get this,
Yeah.
and move on to something you do understand.
Yeah.
I like it.
Eh.
Okay, what's next on our Buffett checklist?
This one might be a bit of a reality check.
Oh,
Before you get too excited about picking individual stocks, remember this.
yeah.
Most professional fund managers, people who do this for a living,
Yeah.
actually fail to beat the market consistently over time.
Whoa, seriously. Even the pros struggle.
Yep. And that's crucial to understand because when you choose to pick stocks,
Okay.
you're essentially betting you can outperform those pros.
Okay.
Statistically, the odds aren't exactly in your favor.
Okay, that's sobering. But wait, doesn't Buffett consistently beat the market?
He does, but he's also the first to admit he's an outlier.
Okay.
His success is due to a combination of factors.
Yeah.
His temperament, his deep understanding of businesses, and a bit of luck.
Right?
It's not a formula you can simply replicate.
So what's the takeaway for someone like me just starting out? Should I even bother trying to pick individual stocks?
It's not about not trying.
Okay.
It's about being realistic.
Okay.
It's totally fine to start with index funds, which essentially track the performance of the overall market.
Okay.
It's a great way to get your feet wet and build a solid foundation.
Okay, so acknowledging the challenge is step two.
Yeah.
Don't get cocky. Start slow, maybe with index funds.
Got it.
Now let's get into something a little more exciting. I keep hearing about this moat concept of Buffett's.
Yeah.
What's that all about?
The moat is a fantastic analogy for a company's sustainable competitive advantage.
Okay.
It's what protects a business from its competitors, just like a moat protects a castle.
I was just picturing like a medieval castle
Right.
with a huge moat full of alligators.
Yeah, exactly.
But what does that look like in the real business world?
Let's take Amazon, for example.
Yeah.
One of their moats is their massive scale.
Yeah.
They're so big and efficient that it's incredibly difficult for smaller competitors to match their prices or delivery speeds.
Right, so it's like they built a moat so wide that nobody can cross it.
Exactly. Other examples of moats include things like strong brands like Coca-Cola or unique technologies protected by patents. Think about Apple.
Yeah.
Their brand loyalty and ecosystem of products create a powerful moat that's tough to compete with.
So how does this moat concept actually help me as an investor?
When you're analyzing a potential investment, one of the first things you should ask is, what's their moat?
Okay.
If a company doesn't have a clear, sustainable competitive advantage,
Yeah.
it's going to be much harder for them to maintain profitability in the long run.
So it's not enough to have a great product or service today.
Right.
You need that lasting advantage, that moat, to really thrive in the long term.
Exactly.
That's a really powerful concept.
Yeah.
I'm already starting to think about companies differently.
That's the beauty of Buffett's approach.
Yeah.
It's about understanding the underlying dynamics of businesses and making informed decisions based on that understanding.
Okay, so we've covered understanding businesses acknowledging the challenge and the importance of moats. What other Buffett wisdom awaits us?
This one might surprise you.
Okay.
It's not all about spreadsheets and numbers.
Okay.
Buffett often talks about the importance of understanding consumer behavior,
Okay.
even psychology.
Interesting.
Remember that famous quote about people valuing their iPhones over a second car?
Yeah, that blew my mind. It's like he's saying investing isn't just about crunching numbers, it's about understanding what makes people tick.
Exactly. Let's take another example.
Okay.
See's Candies.
That's
It's a
good.
relatively small confectionery company,
Okay.
but Buffett loves it because they've built an incredible brand loyalty through their quality and nostalgic appeal. People have emotional attachments to those chocolates.
Wow. So it's not just about the product itself, it's about the feelings it evokes. I'm starting to see how this all ties together.
Right. And understanding consumer psychology can give you a huge edge as an investor.
Yeah.
It's about seeing beyond the balance sheet and recognizing the intangible value that drives brand loyalty and long-term success.
This is great stuff. I'm already starting to see the world through Buffett's eyes. But let's be honest, at the end of the day, we're all looking at that stock price.
Right.
How do we actually figure out if a stock is a good deal or not?
That's where valuation comes in.
Okay.
It's about figuring out what a company is actually worth, and it's a crucial step in making informed investment decisions.
Okay, but valuation sounds complicated. I'm no math whiz.
Don't worry, we'll keep it simple.
Okay.
One of the most common valuation methods is the price-to-earnings ratio, or PE ratio for short.
Okay.
It's basically comparing a company's earnings per share to its stock price.
Okay, so let's say I'm looking at a company like Starbucks, a brand I know and love.
Sure.
Their PE ratio is 30.
Okay.
What does that actually tell me?
It means you're essentially paying $30 for every $1 of earnings the company generates. Now, whether that's a good deal or not depends on a lot of factors,
Okay.
like the company's growth prospects, its industry, and the overall market conditions.
So it's not just about the PE ratio in isolation.
Right.
You need to consider the bigger picture.
Exactly.
What are some other valuation methods I should know about?
Another one is dividend yield, which measures how much a company pays out in dividends relative to its stock price. This can be attractive for investors looking for a steady stream of income. And then there's discounted cash flow, which is a bit more complex, but essentially tries to estimate the present value of a company's future cash flows.
All right, I'm starting to get a sense of how valuation works, but I can see it takes time and practice to really master these concepts.
Absolutely. The key takeaway here is that price is just one piece of the puzzle.
Okay.
Understanding different valuation methods helps you dig deeper and make more informed decisions about whether a stock is truly undervalued or overpriced.
Okay, so we've covered understanding businesses, acknowledging the challenge, finding the moat, embracing consumer psychology, and now valuation methods. Is there anything else we absolutely need to know before diving into specific examples?
Yes, one more crucial concept: margin of safety.
Ooh, I like that.
This is one of Buffett's core principles, and it's all about building in a buffer to protect yourself from potential losses.
I love that idea.
Yeah.
So it's not just about finding a good company. It's about buying it at the right price with a built-in discount, just in case our calculations are off.
Exactly. It's like having a safety net. Let's say you've determined that a company is worth $100 per share.
Okay.
Instead of buying it at $100, you aim to buy it at a discount, maybe $80 or even $70.
Okay.
This gives you a margin of safety in case your valuation turns out to be too optimistic.
That makes so much sense. It's like getting a double discount. You're
Yeah.
getting a great company at a price that's even better than you expected.
And this ties back to Buffett's emphasis on patience. Don't feel pressured to buy a stock just because it's popular or because it's going up. Wait for the right opportunity when the price is right and buy with that margin of safety in mind.
Okay. I'm officially a fan of the margin of safety. It feels like a superpower for investors. But before we move on to specific examples, I'm curious about something. I've heard that Buffett has been holding a lot of cash lately. Why would he do that when the market seems to be doing so well?
That's a great question, and it leads us to one of the most intriguing aspects of Buffett's strategy: market timing.
Okay.
He's not afraid to sit on the sidelines and wait for the right moment to strike.
So he's basically a bargain hunter on a massive scale.
Exactly. He sees his cash pile as ammunition ready to be deployed when the right opportunities arise. Remember his moves during the 2008 financial crisis?
Yeah.
He swooped in and made some incredible deals while others were panicking.
That's incredible. It takes serious discipline to resist the urge to buy when everyone else is.
It does, and it speaks to his long-term perspective.
Right.
He's not chasing short-term gains. He's looking for undervalued assets that he can hold for years, even decades.
Okay, so we've covered understanding businesses, acknowledging the challenge, finding The moat-embracing consumer psychology, valuation methods, the margin of safety, and now market timing. I feel like we've just been handed the keys to Buffett's kingdom.
We've certainly laid a strong foundation. Now, in the next part of our deep dive, we'll explore some of the specific companies that Buffett has invested in and see how these principles play out in real-world scenarios.
I can't wait. This is getting seriously good.
All right, so let's dive into some real-world examples
Okay.
of Buffett's investment philosophy in action.
Okay.
Remember our discussion about consumer psychology? Well, Buffett's massive Apple investment is a perfect case study.
Oh, yeah, that one really stuck with me. The idea that people would rather give up a second car than their iPhone is wild.
Yeah.
What's the deeper lesson there for investors?
It highlights the power of intangible assets.
All right.
We often focus on the tangible stuff like factories and inventory, but things like brand loyalty and the emotional connection consumers have with a product are incredibly valuable, even if you can't put a precise dollar amount on them.
So Apple's not just selling phones and computers. They're selling a feeling, a sense of belonging to a premium, innovative ecosystem.
Exactly. And that translates into pricing power,
Yep.
which is one of the hallmarks of a truly great business.
Mm-hmm.
Apple can charge a premium for its products because people are willing to pay for that experience, that feeling of being part of something special.
Okay, that makes sense. Now let's talk about a company that's been a cornerstone of Buffett's portfolio for decades. Coca-Cola.
Okay.
What's their moat? Is it just that their product tastes good?
Taste is certainly part of it, but the real moat is their global brand recognition. Coke is practically synonymous with refreshment, and that image is ingrained in consumers' minds worldwide. They've achieved an incredible level of market penetration spanning over 200 countries.
Wow, 200 countries. You can practically travel the world and find a Coke everywhere you go.
That ubiquity is a powerful competitive advantage, but it goes beyond just the product.
Yeah.
Coca-Cola has masterfully created an emotional connection with consumers, associating their brand with happiness, togetherness, and good times.
You're right. I'm starting to see their ads in my head right now. All those feel-good moments with friends and family sharing a Coke. It's brilliant marketing.
It is. They've tapped into something deeper than just selling a sugary drink.
Right.
They're selling an experience, a feeling.
Okay, so we've got Apple and their powerful brand loyalty, and Coca-Cola with their global reach and emotional connection. Give me another example. What about a company that's a little less obvious? Maybe one that wouldn't immediately come to mind for the average investor?
How about See's Candies?
See's Candies. Interesting. I know they're known for their quality chocolates, but I wouldn't have thought of them as a Buffett-style investment.
What's fascinating about See's is that they've managed to maintain a strong pricing power, even in the face of competition from larger confectionery companies. People are willing to pay a premium for that familiar taste, that sense of tradition, especially around holidays.
It's like those chocolates are tied to memories, to special occasions. You're not just buying candy, you're buying a piece of nostalgia.
Exactly. And that emotional connection creates a powerful moat, allowing them to charge higher prices and maintain strong profit margins.
Okay, I'm starting to get a real sense of how Buffett thinks about businesses. But let's shift gears a bit and talk about market timing.
Okay.
We mentioned earlier that he's been holding a lot of cash lately. Why would he do that when the market seems to be doing so well?
It might seem counterintuitive, but that's what makes Buffett such a disciplined investor. He's not afraid to go against the grain and wait for the right moment to strike. He said that he sees limited opportunities for large-scale investments at current market valuations.
So he's basically saying that things are a bit overpriced right now.
Essentially, yes. He's waiting for a correction, a dip in the market where prices become more attractive.
It's like he's a master chess player, thinking several moves ahead. He's not just reacting to the current market conditions, he's anticipating future opportunities.
Exactly. Remember his swift moves during the 2008 financial crisis.
Right.
He deployed billions of dollars scooping up undervalued assets while others were panicking.
That's incredible. It takes nerves of steel to stay calm and rational when the market is in turmoil.
It does, and it highlights another important aspect of Buffett's approach, his focus on the long game.
Yeah.
He's not swayed by short-term fluctuations or market noise. He's looking for companies with a durable competitive advantage, buying them at a reasonable price, and then letting them compound their earnings over time.
That long-term perspective is something I'm really starting to appreciate. It's so easy to get caught up in the day-to-day movements of the market, but Buffett's reminding us to zoom out and focus on the bigger picture.
Exactly. It's like planting a tree and watching it grow for years, even decades. The real magic of compounding happens over time, and Buffett understands that better than anyone.
Okay, so we've seen how Buffett's principles play out in companies like Apple, Coca-Cola, and even See's Candies. We've talked about his patient approach to market timing and his focus on the long game. What other nuggets of wisdom can we glean from his playbook?
Well, this one might surprise you.
Okay.
Buffett is perfectly content paying taxes. In fact, he's even said that he's happy to pay them, especially at lower rates.
Wait, what? Most investors I know are obsessed with minimizing their tax burden. Why would Buffett be okay with paying more in taxes?
It's a fascinating perspective that reveals a lot about his investment philosophy. He's not trying to game the system or find loopholes. He's focused on building sustainable long-term wealth through smart investments, and he recognizes that taxes are simply a part of that equation.
It's like he's saying, look, if I'm making a lot of money, I'm happy to contribute my fair share to society.
Exactly, and it ties back to his long-term focus. He's not worried about short-term tax implications. He's looking at the bigger picture, the long-term growth of his investments.
That's such a refreshing perspective. It's
You're
like
right.
he's saying, focus on building a great business and the taxes will take care of themselves.
Precisely. And it reinforces the idea that investing is not just about maximizing returns, it's about aligning your financial goals with your values.
Okay, I'm really starting to internalize this Buffett mindset, but before we move on to the final part of our deep dive, I want to make sure I'm getting this right. We've learned about the importance of understanding businesses, finding companies with moats, embracing the psychology of consumers and valuing companies based on more than just their stock price. We've also talked about the power of patience, both in terms of market timing and long-term investing. And we've learned that it's okay to pay taxes.
Did I miss anything?
Got it. Those are the key takeaways from Buffett's playbook.
Yeah.
Now, in the final part of our deep dive, we'll explore some of the potential challenges and pitfalls that even the most seasoned investors face and leave you with some thought-provoking questions to ponder as you embark on your own investment journey.
Okay, so we've learned a ton from Warren Buffett's approach to investing. We've talked about understanding businesses, finding moats, the psychology of consumers, valuation, market timing, patience, and even taxes. I feel like I've just been through an investing boot camp.
Absolutely.
But before we wrap up this deep dive, I'm curious about something.
Even the best investors make mistakes, right?
Of course.
What are some of the common pitfalls that we should watch out for?
Yeah, that's a great question. And you're absolutely right. Even seasoned investors can fall into traps, especially when emotions come into play.
Okay, so let's talk about emotions.
Mm.
What are some of the emotional traps that can sabotage even the most well-intentioned investor?
One of the biggest ones is fear,
Okay.
especially the fear of missing out, or FOMO as it's often called.
Right.
When everyone else seems to be making money in a particular stock or sector, it's tempting to jump on the bandwagon even if you don't fully understand the underlying business.
Oh, I can definitely relate to that. It's like that feeling you get when everyone's talking about a hot new restaurant and you feel like you have to try it, even if you're not sure you'll actually like the food.
Exactly. And in investing, that fear of missing out can lead to impulsive decisions, buying stocks simply because they're going up without doing your due diligence.
So how do we avoid falling into the FOMO trap?
It goes back to those core principles we discussed: understanding businesses, finding moats, and having a solid valuation framework. If you're not comfortable with the underlying business or the price you're paying, don't buy it no matter how much hype there is.
Okay, so FOMO is a big one.
Yeah.
What are some other emotional traps to watch out for?
Another common one is panic selling. When the market takes a dip, it's natural to feel anxious and want to sell everything before it drops further. But remember what we discussed about market timing?
Right.
Buffett sees those downturns as opportunities.
Right. He's the bargain hunter waiting for those moments when everyone else is panicking.
Mm.
But it's easier said than done, isn't it? How do we stay calm and rational when the market is going crazy?
It's not easy, but having a long-term perspective can really help. Remember, you're not investing for tomorrow. You're investing for the next 5, 10, even 20 years. Short-term fluctuations are just noise.
That's such a powerful reminder. It's
Oh,
like
yeah.
zooming out and looking at the market from a different altitude, where those daily ups and downs just fade away.
Exactly. And having a diversified portfolio can also help mitigate risk. Don't put all your eggs in one basket. Spread your investments across different sectors and asset classes to weather those inevitable market storms.
All right, so we've talked about emotional traps like FOMO and panic selling. Are there any other common mistakes that even experienced investors can make?
One that often comes up is getting too attached to a particular stock.
Okay.
It's great to find companies you believe in and hold them for the long term. But remember, businesses change, markets evolve, and sometimes it's necessary to let go, even if you have an emotional connection to a particular company.
Oh, I can see how that would be tough. It's like having to say goodbye to an old friend.
Yeah.
But I guess that's where that rational analytical side of investing comes in.
Exactly. It's important to reevaluate your investments periodically and make sure they still align with your goals and your risk tolerance. Don't hold on to a stock simply because you've owned it for a long time. Be willing to make changes when necessary.
Okay, so we've covered emotional traps, the importance of diversification, and the need to be willing to let go of investments that no longer serve us. Any other words of wisdom before we wrap up this deep dive?
Here's one that I think is particularly relevant in today's world of information overload. Don't get caught up in the noise. There's a constant stream of news, opinions, and predictions about the market, and it's easy to get overwhelmed.
Oh, I know what you mean. It's
Yeah.
like trying to drink from a fire hose.
Exactly. It's important to filter out the noise and focus on the fundamentals. Remember those core principles we've been discussing: understanding businesses, finding moats, valuation, patience. Those are the timeless principles that will guide you through any market conditions.
That's such a great point. It's like finding that quiet space in the midst of all the chaos where you can focus on what really matters.
Right.
And I think we've covered a lot of ground here as we wrap up this deep dive. What's the one takeaway you'd like to leave our listeners with?
I'd say it's this: investing is a journey, not a destination. There will be ups and downs, triumphs and setbacks, but if you approach it with a long-term perspective, a willingness to learn, and a commitment to those core principles we've discussed, you'll be well on your way to building a solid financial future.
I love that investing is a journey, not a destination. That's something I'll definitely be reflecting on. Now, before we say goodbye, I want to leave our listeners with a challenge, something to really ponder as they embark on their own investing adventures. Imagine you could only own one business in the world. What would it be and why?
Ooh, that's a good one.
Don't just pick a company because its stock is doing well right now. Think about the long term. What business would you be proud to own even if the market took a downturn? What company represents those enduring values and principles that we've been exploring today?
Yeah, that's a fantastic question to ponder. It forces you to think critically about the qualities of a truly great business and to apply those principles to your own investment decisions.
And remember, there are no right or wrong answers here. It's all about developing your own investment philosophy, your own framework for making decisions. So take some time to reflect on this challenge, and who knows, maybe it'll lead you to your next great investment idea.
Absolutely.
Well, thanks for joining me on this deep dive into the world of Warren Buffett. It's been an incredible journey, and I feel like I've learned so much.
It's been my pleasure. And remember, the best investment you can make is in yourself. Keep learning, keep growing, and keep exploring the fascinating world of investing.